Hello everyone, welcome to my channel. Today I'm going to explain my finance project on financial instruments and investment portfolio analysis. We'll look at equity, debt, and mutual funds and also see how different investor categories should balance their portfolios. Let's begin. First, let's understand what financial instruments are. A financial instrument is simply a contract between a buyer and a seller that can be traded in the market. These instruments carry value and can be bought, sold, or modified depending on the needs of other both parties. Next, we have equity shares. Equity means ownership. When you buy shares of a company, you actually own a part of that company. You get voting rights, dividend benefits, and claim on company assets. Then we have debt instruments. These are used when companies or governments borrow money from investors. In return, they promise to repay with interest. Examples: bonds, debentures, and commercial papers. Lastly, mutual funds. Here, money from many investors is pooled together and invested in stocks, bonds, or both. A fund manager handles all investments on behalf of investors. Equity funds invest in stocks, debt funds in bonds, and hybrid funds invest in both. Now let's move to the first portfolio trade, comparing three instruments: Reliance Industries Limited 10-year Government of India bond and HDFC Nifty 50 Value 20. Reliance is India's biggest companies and has high growth potential but also comes with high risk. Government bonds are almost risk free because they are backed by India government. And HDFC Mutual Fund invests in the top 100 companies and give diversification. In terms of risk and return, Reliance has very high risk but high 1 year returns. G6 are safe with around 6.5 to 6.57 returns. The mutual funds has high risk but negative 1 year performance in this case. In liquidity, equity has the highest liquidity. Bonds are harder to sell before maturity, and mutual funds are moderately liquid. Taxation varies between short term and long term gains. So, this is the graphical representation, and then here this table shows how 1000 rupees grows in each instrument over 1 year. You can see Reliance grew the fastest, ending at 1170 rupees. Government bonds grew steadily to about 1066 rupees. And then HDFC Nifty 50 value 20 sli- declined slightly to 967 rupees. This shows how equity is volatile but can give strong returns, while debt is stable but lower. Mutual funds depend on market cycles. Now let's see which investment suits which different age groups. Senior citizens 70% in government bonds and 30% in mutual funds because capital safety is the priority. Middle age investors 60% in mutual funds, 30% in bonds, and 10% in Reliance, balancing safety plus growth. Young investors 60% in mutual funds and 40% in Reliance, and aggressive but diversified. Next, we analyze Bharti Airtel Limited, State Bank of India bonds, ICICI Nifty Infrastructure ETF Mutual Fund. Airtel represents India's fast growing telecom sector. SBI bonds are medium risk with higher yields than government bonds. The infra ETF tracks companies linked to India's capex growth. In returns, Airtel grew the highest in 1 year, followed by the ETF to India's capex growth. This is the graphical representation. And then next, here the 1000 rupees growth simulation shows Airtel grows the most, ending at 1306 rupees, and SBI bonds reach 1077 rupees, and the infra ETF ends at around 1078 rupees. This reflects India's strong telecom and infrastructure performance. This portfolio suggestions senior citizens 70% in SBI bonds, 30% in infra ETF, middle age 45% in ETF, 40% in SBI bonds, and 15% in Airtel. Young investors 60% in infra ETF, 40% in Airtel for aggressive growth. Then we go to the trade analysis 3, the final trade. That is Nestle India, Tata Capital Financial Services, a AAA rated safe bonds, Motilal Oswald 5 years, GSEC ETF MF. Nestle is a defensive stock during market volatility because the risk is moderate high. The Tata Capital bonds offer high safety as the risk is low. The Motilal Oswal ETF track government debt efficiently, and the returns are 9.65 for Nestle, 7.8 to 8.8 for Tata Capital, and 7.89 for Motilal. This is the graphical representation, and then here the 1000 rupees investment grows like this. Nestle ends at 1097 rupees, Tata Capital ends at 1086.4 rupees, Motilal ends at 107976.2 rupees. This shows stable and low risk returns across all three. Okay, based on goals, senior citizens 50% in Motilal Oswal and 30% in Tata Capital and 20 in Nestle. 40 middle-aged people 40% in Motilal Oswal and 30% in Tata Capital and 30 in Nestle India. Young investors invested 50% in Nestle, 50% in Motilal, and 0% in Capital Financial. And that wraps up the complete investment portfolio. And that wraps up the complete investment portfolio trade analysis across equity, debt, and mutual funds. I hope this breakdown helped you understand how different instruments perform now, how portfolios can be customized based on age and goals. If you found this video useful, don't forget to like, share and subscribe. Thanks for watching.